Remember, it's a great time to invest into the debt vehicle right now because it's paying close to equity level of returns. And the IRR is actually really high.
Welcome everyone to our Hero Capital Show. I'm your host Tim Mai, and today I have my good friend. We he goes by BD, and his name is longer than that. I'm gonna have him explain it to you, but his name is B Dweik, and he is the co-founder of Bluestone Flagship Investors. BD is a seasoned professional with the background in technology, engineering, extensive experience as a passive real estate investor. His is to empower busy professionals to invest in meticulously vetted, and it's very true when he says that word, meticulously vetted, cash flowing real estate opportunities, and allowing them to safeguard their assets amidst economic uncertainty whilst simultaneously building long-term wealth. He's been investing in real estate since 1997 for a long time. He has similar to a family office type structure. And yeah, he doesn't quite raise capital like most of us syndicators and fund managers raise capital. He invests in these deals and he allowed some friends, family, associates to come in and invest alongside with him. And so a bit different. So we're gonna dig into all of that and also to what all the types of assets he invests in. So with that, BD, let's start out with if you can share with everyone what your full name is and slowly teach us how to pronounce it.
No problem, Tim. Thank you for the platform and thanks for the invite. Grateful to be here and I guess grateful here for the audience as well. My name is a composite name. It actually has two parts. The first part is Badawi, which means a nomad. And,
slow,
like a
slow,
nomad, the
slow,
person,
slow it down for
yeah,
us. Say it again.
sure. I can spell it out. No, it's Badawi, which means a nomad, like
Battery.
a Bedouin. No,
Okay.
Badawi, like a Bedouin, the nomad,
Okay.
the person
Battery.
that lives in the
Okay.
desert. Yeah, Bedouin. And then the second part is Fuad, so Fuad, which means heart. So the composite name means the heart of a nomad.
Mm.
So the interesting story about BD is, as I started going to conferences, my name was too long to fit in a one of those tags, so people can make up the B and they can make up the last D. So they started calling me BD, and that really got stuck in there. So there you have the myth has been
That's awesome.
has
I
been
love that.
exposed. No
Yeah.
problem. And then the last name is Dweik.
Gotcha. Okay, now I got it. Thank you for that. Yes. So, yeah, so share with us a bit about your background. What were you doing in tech and how did you get started in real estate investing?
Yeah, no, it was really a fun journey. I graduated electrical computer engineering and I started working at IBM Micro, which is the division of IBM that design chips. And a big part of my job was to fry chips, not the potato ones, but the electronic chips. When I first took my job at IBM, my manager was asking me, "Where are you now?" Because I had to relocate from Boston to go work for IBM. And I said, I rented a two-bedroom apartment. He's, "No, you should really buy a house and rent out rooms." And this was in 1997. So all of a sudden, I became an accidental landlord. Personally, I didn't know a whole lot about renting and or buying even, or what a mortgage is. I'm still a first generation immigrant, pretty much. Came here at 16 and just went through life. So very quickly, I had to learn about real estate. What is a real estate? What's a mortgage? And what are the various different aspects of being a landlord very quickly.
Mm.
And that's how the journey started. But I've always worked in tech. My background has been in silicon design or chip design. And I've had a decent career, about 23 years in tech, where I was full time in tech, but I was always investing in real estate, just actively buying properties. And when I moved to the Silicon Valley in '06, I started buying here, I would say in '09, after the market has corrected, and got more sophisticated where I started buying short sales and uh,
Ah.
doing a little bit more elaborate. I would say my first attempt to passive investing was most about me writing a check, closing my eyes, and sending the money. I was probably about 2017. And from then, how the market was just great. You could just send money and then money comes back. But over time, I got to really understand, hey, what's a good deal? What's not a good deal? Returns were always coming back. There was just no issues. And up until like 2020 and 2021, when interest rates start changing, now you start seeing the differences. But that's a little bit about me, a little bit about my real estate journey. I've worked in three publicly traded companies as well as 3 startups, one of which got bought by Cisco.
Oh,
Also on
wow.
the call is my co-founder, Jesse Rogers, and that was like the phase 2 of me turning from a tech professional into a full-time real estate professional. So it's good to have Jesse here as well.
Wow. Good to meet you, Jesse. Oh, yeah. Actually, we met in Dallas. That's right. We met in
Correct.
Dallas a year ago. I'm coming back in Dallas in April. So do come and hang out with us, Jesse. Okay. Yeah. Fascinating. So 2017, you got into passive investing. And since then, are you still buying properties where you are the owner on, or is it all, when it comes to real estate, is it all passive investing at this point?
So great question. So I would say in about 2019, where I decided to basically exit tech, I started looking into becoming a full-time real estate investor. And part of that's really where me and Jesse we met. And it was in like a multifamily commercial real estate
Oh,
class.
okay.
We both did our certificate in commercial real estate investing, and our goal was to really go start our deals. So we actually, right in the midst of COVID, we acquired the first commercial building. So we're actually active investors buying actual properties, and our focus is triple net. We really like triple net. We buy really distressed triple net, all cash, place back a tenant in it, stabilize it, refinance it, and sell it as it actually appreciates. So while we're doing that, we brought along a few investors to just help us out, raise all the cash. We did not do a GPL; it just was purely a JV type structure, just the 4 of us. And on our first flip, actually, we call them a flip because it was just quick turn. We pretty much were lucky to put it under contract at an amazing place, and somebody comes and pays us 50% more within 6 months
Wow.
without us touching the building. We're like, okay, we'll
Nice.
sell it. We made money, the investors made money, everybody's happy, but everybody's like, hey, what is the next deal? People's appetite pretty much opens up, and we're like, we don't have enough of those type of deals, and we're very picky on the type of deals. Jesse spent tremendous amount of time networking, connecting, getting all the deal flow, but it's really hard to get solid deal flow in the commercial triple net. So we're
I
like,
see.
okay, we started opening up to other investors. I was like, hey, I'm passively investing in these things. Would you be interested in investing alongside because we can negotiate? So a lot of my friends from tech started investing, and then we would literally go to sponsors like, hey, we're going to invest as a group. And then somebody recommended, hey, maybe you guys should structure into an SPV or into. So drill into that. Fast forward, Badri from Avister was constantly connecting me. I was like, okay, maybe it makes sense for us to structure one entity that allows us to invest as a group and onboard like-minded investors that want to invest alongside of us. So that's really when Bluestone Flagship was really co-founded in 2022. And our mission is basically to find well-vetted investments. We're ready to basically put capital in to passively invest and bring along a lot of our other investors, which typically a lot of our network in tech. Both me and Jesse are tech professionals by trade. So
Right.
that's really where our network is. And both of us are super passionate about real estate investing. So that's really where the cross that happens.
Interesting. So share with us, because the legal structure that you're using sounds just like a typical fund of funds structure. Why do you call it that you don't raise capital, you bring investors along, even though it's like it sounds just the same, it's just a different way of raising capital and positioning it differently? Do you not charge any kind of like fund admin fees or anything like that? Or like what makes the way that you structure it with your LPs, because they do come into your fund as an LP, right? What makes it different from you call your LPs and what you do with them versus what we call our LPs that we raise money from them into our deal?
Sure. Where you're in the business of a fund of fund, at the end of the day, you have expertise in being able to get the deal flow and vet deals. And on the other side, you actually do have your investors, which are their LPs. And again, big part of what you're trying to do is really trying to match the deal flow with your investors.
Yep.
That naturally by itself, you're spending effort and time, and that effort and time, you're going to get rewarded, whether it's through fees you're going to get from the sponsors as a co-GP or in a fund of fund model, a spread between the deal economics that you get for your fund versus what you pass on to your investors, right? Somehow you have to get paid for it. So effectively, in a fund of fund model, your job as a part of your task is capital raising, because again, you're really trying to create that improved economics. So I'll say what we do is similar, yet slightly different in the sense that we don't go say, hey, I need to raise $1 million for this deal. We actually have the deal flow. We look at the deal flow. We vet the deal flow. When we find a deal, we try to negotiate in economics with the sponsor, get a feel about, hey, what threshold of economics we need to do. And if it fits within our criteria, if it fits within what we would like to invest in, we go in and meet with our LPs and we're like, okay, here's this deal. We really like it. Here's the upside, downside risk. So it's a little bit more than us just pushing email marketing to people to try to get people. It's really about educating our investors about this deal and why this deal makes sense for us and why we want to invest in it. And that's really the key part is we are investing in it in every deal that we actually bring in on the passive side and see, hey, what kind of traction within our LP investor partnership that we have, they're interested in this. Once we get a feel for it, we actually go in and actually subscribe as a group. Now, the improved economics that we are negotiating with sponsors flows back to our LPs, 100%. So we're not really sitting there and trying to actually get a cut. And then when it comes to the expenses related to actually running this vehicle, running this LLC, effectively running this partnership, it's all shared on a pro rata basis. So if I'm actually naturally the largest investor in the fund, effectively. I think about it that way because I'm investing in every deal. So naturally, when it comes time to do a pro rata share of expenses, I am actually the biggest expense payer for the entity because
Gotcha.
I carry majority of the cost. So these are some of the nuances, if you want to think about it. That it's different. It's not like we're trying to get a deal at one rate and pass it on to the investor. And there's nothing wrong with that. That's just a standard fund to fund model. But this is just how we're unique and different about it.
Would you say that it's more similar to an investment club, but using the fund legal structure?
It's a little bit more than an investment club because in an investment club, you're finding like-minded people that you want to invest together and you run your investment. Versus in Bluestone, we like to think about it differently because the level of relationship that we have among the investors, among the LP, we decided to go deeper and narrower. Because at the end of the day, I look at the amount of time that I need to manage. Managing 20, 30, 40 investors is very different than managing 200 LPs. And we want to spend very little of the time basically with the administrative level of task. So in an investment club, it's much, much broader. So the way we actually look at it is we're not only just looking at deals in real estate, we're looking at deal in debt, we're looking at deal in private equity, we're looking at deals in, the way we look at it and pretty much think about it more as a family. And each one of us want to invest in various different things. Why not standardize how we're looking at things, how we're analyzing things? So it's not just me and Jesse analyzing things related to this. Anybody, any of the LPs that have a specific skill set in analyzing a different type of an investment steps in and takes over some of that capability and does the recommendation back to the group. If we decide to bring it on to the broader group, it actually they have to participate, and that's kind of part of our mandate. They have to participate as part of the deal. Hey, you cannot bring an angel investment thing and not put money on it or run the due diligence on it. So it's really about having a much tighter. An investment club, it's a lot broader, and not many people bring in deal flow. For us, anybody from the LP can bring in a deal. We vet it. Once it meets the criteria, we would open up for the rest of it. So these are probably some of the nuances that we found.
I
So
see.
some nuances different from a club, some nuances different than a fund of fund, but
Right.
effectively the same thing. We're taking money and we're deploying it in investments.
Very cool. All right. So now let's talk about, especially around real estate, what type of assets are you looking for? And obviously, you also mentioned debts as well. What type of investments are you looking for? And do you have a buy box, your investment criteria? Give us some insights into that in case there's people on this call that has a deal that would love for you to invest in, your group to invest in.
Constantly, we're always looking into getting the highest level of return at the lowest possible risk. And in many cases, that's not a fixed formula from a buy box. Because if your objective is to get a highest return at the lowest possible risk, you have to factor in market dynamics, you have to factor in interest rates, you have to factor in the GPs, you have so many different factors. But people say right now, what are the type of deals that you would look for? And I would say right now, we're really into debt. We like triple net. We like certain things that are not affected by insurances. And for example, multifamily, people say, oh, well, it's still a great time to buy multifamily. Agreed. We already have tons of multifamily in the portfolio. So we're actually good there. Even when we bought multifamily 2 or 3 years ago, we had very specific criteria about which city, which operator, where we actually invest in multifamily. But when it comes to right now, I would say we're really looking at debt, like first lien position, bridge debts, fix and flip. But again, it's more of the nuances when you're looking at debt is like what's really the underlying, what are the parameters of this debt that can get you the highest level of return at the lowest possible risk. Do we take more risk to get higher yield? Absolutely. That's why we're looking at things like business loans. That's we're looking at things at like flight school tuition. We're really open to taking anything in terms of investment, but at the end of the day, we weigh it against various different things, and then we present it to our LPs with what we like about it, and then pretty much see, hey, is there an avenue to actually open this as the next round of thing to invest in?
I see. Okay. So when your sound was going in and out like it switched like earlier, but I want to make sure you can hear me. Can you hear me okay? Okay, good. So when you're talking about debt, you're not talking about just real estate debt, but it sounds like you're talking about other types of business debt, flight school type of tuition debt. That's interesting. I did, yeah. So when
Invoice financing, invoice financing. Remember, it's a great time to invest into the debt vehicle right now because it's paying close to equity level of returns. And the IRR is actually really high. The IRR, because you're not waiting after 5 years to really get your big return. It's literally paying out monthly or paying out quarterly. So that's really where the debt product overall, it doesn't matter whether it's real estate based or business based or however, is super interesting at this time or has been interesting for the last 2 years for us.
that is, yeah, and more recently, it seems like I come across more people that deals with debt, all kinds of debts. Yeah, it seems, yeah, these days. So that's very interesting that you're heading into that direction. And then on the real estate side, you mentioned triple net. So on the triple net, are you investing as an LP, or are you just looking for them to own those assets like you did your first one there?
Yeah, I mean, for triple net, we look at both passive side as well as the active side. On the passive side, again, the biggest risk in the triple net is the credit of the tenant. And right now, we're looking at a medical office, a roll-up strategy with a sponsor to invest with them passively. But at the same time, on the active side, that's really where Jesse's and my expertise, let's just say, is really. So these will be like smaller deals, commercial plaza, 2 to 5 million is really a sweet spot in the Midwest where we buy them, they're distressed, and there's a huge value add potential to improve them, stabilize them. So these will be individual syndicates that we can actually start as individual deals, stabilize them, get the cash flow. But again, we have the network, we have the investors and the capital, but as long as it fits our buy products. So that's
I
really
see.
more on the active deals. But these, like I said, are very opportunistic. If they come, if they don't, we're not betting on it because we're constantly reinvesting our.
Gotcha. Okay. Let's talk about due diligence because whenever you're investing passively, you're either A, investing with a syndicator or B, investing with a fund manager. What is your due diligence process, vetting process like for that fund manager, that syndicator that you're investing with?
Yeah, so it is quite expensive, but the way I like to think about it, it's the people, it's the market, and then it's the product or the deal.
Mm,
And then 50% of the weight is really the GP and the GP team. So that what are the attributes and there's no secret sauce in what we do. It's just we go through the mechanics of evaluating these aspects. But we would put a lot of weight on the GP. Then we understand the market. Does the market have what it take to actually raise the rents or get that level of occupancy and so forth? And then lastly is the deal. And then out of the deal itself, believe it or not, almost 30% of the deal, whether it's a yay or an nay, is what the loan structure look like or what the capital stack looks like. That's just like a huge part where it actually swings.
mm,
So people come at me and they're like, "Oh, there's this great Oklahoma property and fantastic," and then it just doesn't even meet the cut because we start with the GP team, then we go with the market, and then lastly we get to the deal. We cannot be too quick just looking at the deal. You really go through the methodical way of doing it. And you do it enough times and you come up with your various different checklists. And the next thing you're like, hey, is there a way to automate it? So we came up with a strategy that we can literally take every deal and purely deal with it from a very systematic way, where we look at all these options that we can have like a screener. You can think about it as a deal screener. We take all the inputs, we plug them into this Excel sheet. It has different weights for the various different aspects. And then it comes up with, hey, does it meet the threshold or does it meet the threshold? If it met the threshold, means we do due diligence. If it didn't meet the threshold, we say thank you. We're gonna pass on this deal. Now, me and Jesse, we're two techie guys, and we like to geek out every once in a while. So every Friday at 11 p.m. at 11 a.m. Pacific, we typically meet and we geek out. And right now, Jesse's writing a custom GPT to do that deal screener for us,
Oh,
and we're
nice.
laughing about it. We're like, wow, that's a cool tool to even give to passive investors. Imagine a GPT you subscribe to, and then you throw in a deal. You literally upload the deal file, and then it comes back and tells you yay or nay. Wow. So anyway, we like to geek out and do fun stuff like that. It's just
That
a fun thing for us.
that's awesome. Yeah, I love that. And with those deep research these days, deep reasoning, it gets pretty good. Yeah. So I'm looking forward to all of the launches that are happening this week between all the different AI platforms. But regarding the GP that you're looking for, obviously there are the biggest GPs out there that has lots of properties, and then you have on the other end you have the newbie GPs that doing their first few deals, and you have in between. Do you have a preference of who's the type of GPs that fit your criteria on that swing?
It's a great question. So, for example, 2 years ago, beginning of January, we said, hey, if we're going to invest into a multifamily deal, we need to see a 6% cash flow or better. And all of a sudden, like we started having deals come in that actually meet that cut. And a lot of these deals did not come from the major multifamily. So we liked, there was some, like, call them rising stars, new people in multifamily. So we actually took a bet on them based on the character, and they've only had 2 or 3 deals under their belt. We're like, hey, it's worth
Mm,
definitely rolling the dice and testing them out. It is in a strong market that we like. The economics of the property makes sense, the cash flow makes sense. And we've been very fortunate. Like on that particular deal in Dallas, Jesse even did the on-site due diligence with the GP, and they were able to increase the NOI in 2 years about 50%. I call the NOI that's the truth or the lie. A GP can send me any type of asset report or status report, but at the end of the day, I track the NOI, and if the NOI keeps going up, it tells me they're doing a good job. Take all the metrics, throw it out of the door. At the end of the day, if they can continue to make the NOI and exceed their NOI targets, that's really the make it or break it of any deal. So yeah, there are times when we take a risk, but again, what we do is we go to our investors, we say, hey, there is an operator risk here. This is the first time, but we think this person is a star, is capable of doing it. We like the deal, we like the market, we like the property, we like the capital stack, we like the loan that's on it, et cetera, et cetera, et cetera. And that's really what we do. So instead of putting, let's just say, 100K per investor, we scale it back to a 50K per investor. And then we subscribe a shorter amount to really see how they are. If we
mm.
like it, they come up with the next deal in about a year, we can go a larger sum onto the next cycle. So yeah, no, always be open to try new sponsors. Don't just limit it to the larger guns. Scale back on the investment till you really try things out.
Very cool. I love that. All right, let's talk about, even though you don't actually raise capital, but I'm curious as to where your investors come in from. You mentioned that some of your associates, your contact from the tech world, and then beyond those immediate contacts that you have, does your group grow continuously through referrals, or do you actively look out for these people at all?
Yeah, so for us, we like to look for like-minded investors that would have similar philosophies about just investing. We're not necessarily looking for the next person with the 50 or 100K check saying, hey, I want to invest in a deal. So the first part of your question is, hey, where do we get lead? We constantly like to be very transparent and publish what we do, own social media, not to promote specific deals, but just to promote the thought process about how you go about investing, the thought process, how you understand real estate. People read so much and hear so much in the news about, oh my God, commercial loans are melting. And I constantly have to deal with that, educating my own investors, my own LPs in Bluestone about where things are. So naturally, you have to do a lot of research. We're like, hey, since we're collecting a lot of research and collecting a lot of intelligence, let's really share that out with the public to really magnetize our profile by attraction. So we don't do any active campaigns where we're targeting. We just basically take the knowledge, take the expertise, and become effectively a platform to teach people about things. If we can teach more and more people about real estate, and it helps other people who are capital raising and investing in deals, by all means, like we think we're doing good for the board. They might not, a lot of these people might reach us and they may not necessarily fit our criteria for passive investors, which is okay. But we can refer them to, hey, other sponsors, or we can tell them, here's a deal we're looking at. Maybe you should consider investing with this sponsor or anybody else that's promoting this particular sponsor. So at the end of the day, like I said, from a marketing standpoint, social media is a big part. We do tons of educational stuff. I'm really passionate about education and at more than one level. We do tons because we feel the more savvy and sophisticated our LPs are in our group, the easier the conversation is to be had. And if that tangentially can help and impact everybody else, why not? And for that, actually, we're developing a whole mastermind just for passive investors right now. We've created right now, we're about 20 modules. It's still in the making. We have not necessarily launched it, but it's going to be somebody, you can think about it. Our avatar is somebody that works in tech, his wife works in tech, or high income, high W2. They can't necessarily get the benefit of a real estate professional, but at the end of the day, so much of their money is tied into their RSUs, which is the stocks from their companies, their 401ks, and everything else, and they want to diversify and take things to the next level. So that's really the avatar that we go at, but we really use social media to broadcast and get the message out.
That makes sense. Yeah, your marketing is very similar to what us capital raisers do to attract our investors for our own avatar, right? Putting out education out there that's applicable to our avatar and nurture that and educate them, nurture them, establish that relationship, and then ask for the money. It's just, that entire process is just very different, very much the same. I'm curious if someone here on the call decides to go after the tech market, the tech investors, like how, and they don't live in the Bay Area, because it seems like that's where all the tech investors are, in the Bay Area. But if they don't live in the Bay Area, how can they approach that market, that
Avatar.
avatar? Yeah.
Yeah, great question. So here is the deal. People mostly in tech are engineers, and a lot of capital raisers here, I'm sure they can tell you how much pain in the neck engineers are because they are highly analytical people. And the problem is they're very high analytics, but they're also very low in knowledge when it comes to financial knowledge. So the best way to win over that crowd is to educate them. Because since they're highly analytical, use that as a weapon to your advantage. So give them stuff to analyze, but at the same time, first, you need to bring up their knowledge. So invest the time to educate them about anything that you're doing, why this investment makes sense, why cap rates are compressing, why cap rates are not compressing. Why, so don't just focus more on the deal. Explain to them what does cap rates compressing mean. Explain to them why does things in Dallas sell, like I tell people, a cap rate is a very sophisticated way of telling PE. If you trade stocks, they understand stocks. Tell them
I
a
see.
PE is the inverse of cap rate. If you take cap rate and you flip it, 1 over cap rate, it's a PE. It's how much, what's the price to earning ratio? How much you're willing to pay, which is NOI, price, the purchase price for a specific income, price to earning ratio. Cap rate is just the inverse of that. So walk them through that process. Say, hey, I have a property that is producing this much income, like a PE, and it's valued that much. And my goal is to increase the income on that property that much. What do you think would happen to the price from a PE ratio standpoint? They would get that. So you really have to get to their level of understanding these financial or real estate metrics and slowly don't start with cap rates. You're just going to confuse them. So you really need to understand how they see the world. They see the world in the stock market. They see the world in things that are more familiar to them, things that, so I would say the best way is to go teach that avatar. Teach them about, imagine yourself giving a commercial real estate class and teach them what really matters. So start them here and educate them And then all of a sudden, floodgates would open.
Gotcha. Yeah. And it's very clear that education is a huge part of what you do and how you grow your community and how you, yeah, educate, nurture, build relationship with your community. So with this mastermind you mentioned, is that going to be a free group or is it going to be a paid premium membership?
We're still contemplating on the business model. I'll tell you, we're weighing out different options. One of the options is, hey, if you give it for free, nobody would see it's a value. And
Yeah.
we're putting a lot of sweat, blood, and tears in there. And then the question comes in is, okay, if you want to charge for it or create a membership, now you have to sit there and convince people why should they subscribe. Probably the third option will be like, hey, just charge enough, like $200, but here's the value of everything you're going to get. And it's really up to the people. We're not going to make money, trust me, on this mastermind, let's just say from a subscription standpoint, but we want to spread the knowledge in a more systematic way, a broader way to really hit the masses. So, in some sense, like I said, not many of these investors that are going to buy this mastermind might be a good fit for Bluestone, but I think they will be a great fit for anybody else that's capital raising. So, we feel like in some sense, we're helping the knowledge, and by helping the knowledge, expanding out to the world there to enable more capital raisers, reach out more people that are more educated to really simplify the process.
I see. You mentioned a few times about not qualified to be a Bluestone investor. Are you looking for a certain check size of investor, or like what makes someone an ideal investor for your company?
I would say submit an application and we can walk you through it. No, I'm kidding. Uh, no, we're looking at, again, remember, we're an accredited entity. So at a minimum, they have to be accredited. They have to have the intent and the interest in terms of investing in real estate. We're not looking for somebody to come in and deploy one capital in one deal in one time.
I
They
see.
truly need to believe in hey, I really need to deploy money in real estate. And it's not just one time thing. We really see a value in real estate. We're convinced this is the way to go. And we like what you're touting. We believe in that. We want to be part of it. That's one part. Another part is like, hey, what value do they bring back to Bluestone? What value does this new investor that's joining the group is going to bring value to the existing 20 people in the group? If you think about it, at the end of the day, every time you're adding a partner, it's not just about their money and deploying in that one deal or the next two deals or three deals, but what value do they actually bring to the rest of the group? Somebody that comes in and says, hey, I've invested in Angel and here's my track record, and I'd love to bring in more deal flow of Angel. I can vet PE deals. I have these really. So at the end of the day, it's just
Mm,
not just how much value they're going to bring, not how much dollar they're going to bring, but really how much value they're going to bring the overall group. So that's really the big part. Do they want to invest in other things outside real estate? Do they want to invest in other alternatives? For example, do they have experience investing in other alternatives? So again, we really look at multi-factor ways to say, okay, this investor is coming in, is there a net positive outcome from what they can bring to the group? And based on that, we can. Now, if they can come in and we don't really feel like there's a fit, or in many cases, we've actually told them, thank you for coming in, thank you for your interest. I understand you want to deploy money into a real estate investment. Here's the next investment. Here is the sponsor, or here's the name of a fund that is actually, why don't you consider actually going? So we've actually done these type of referrals.
interesting. Very good. Okay. And across, I guess, your portfolio allocations, Bluestone, what's the percentage that real estate makes up of in that allocation?
So dollars or deals? It's a
Dollars.
little bit
Let's
hard.
talk
Since we kicked off in 2022, we've invested in 9 different syndications just in Bluestone and one debt offering. So 10 different deals. We've evaluated well over 300 deals. Like all of 2024, we've done only one debt deal because we were still new into debt, evaluating, learning on debt. We did one offering. We didn't want to make it too large of an offering. We said, hey, let's try out this new sponsor. We like what they're offering. Let's deploy that and then scale. Right now, we're actually looking to double down on that or
Mm,
even expand more offerings. So ideally, if all things are going well, we would like to do about 3 to 4 good investments per year. The way we think about it, 3 to 4 solid investments that we can look back, wow, this was a good year. We're not looking to deploy, have a deal every month or rush. Because remember, we are not in the capital raising business. We do not make money if if we do more deals. The way we make money is we're investing the money in the deal and we're getting preferred economic.
Right.
So at the end of the day, there's also a limited amount of capital, how much me and Jesse can invest in these deals. At the end of the day, you start becoming capital dry, right? In terms of being able to invest. So at the end of the day, we have deals exiting likely this year. So we're considering 3 to 4 deals a year is a good solid investments to do.
That makes sense. And so is that 3 to 4 real estate deals or just whatever kind of deals?
Let's just call it, if it's outside real estate, like for example, if you want to invest into an angel investment, right? Typically, you don't want to be writing a check more than 100K. So on the back end, you break that 10 ways, 10K a piece. So it's not
I
really,
see.
it's
Okay.
not really, because remember, when you're investing in an angel, I call it spray and pray. So you spray your money across several different angel deals. So nobody should really invest. I don't know. Everybody can do what they do. But like the way I look at it is I don't want to invest 100K in one angel investment in one deal on with my own money. But would I risk 10K? Sure. Would I risk 10K over 10 different angel investments? Sure. But those are like the smaller type of stuff. And not everybody
Right.
has the appetite to invest in angel. It's a very high risk, high return profile.
That
Um,
makes a lot of sense. Yeah, one time I invested 100K in an angel deal, and gosh, yeah, it was my first time because I'm used to real estate. Like real estate, 100,000 is your is your normal, yeah, your like base standard. And so that was my mindset. And man, I was so scared of, yeah, it was a rough ride, but I ended up getting my money back. Thank goodness. Didn't,
you're ahead of me then. You're ahead of
yeah.
me.
Yeah, didn't make any money, but at least I got my money back. So that was good. So now I know that angel, you're not supposed to invest a lot of money. It's good.
It's called
Um
pray and pray. That's the strategy.
spray and pray. Okay. So as a group, when you go into a real estate deal, what's your typical amount that you bring into the deal? Is it million, 2 million type of or more?
Well, honestly, it varies how many investors resonate with that specific deal, how many investors are ready in time for that specific offering. So it really varies. But we would like to, and then sometime, hey, it's a brand new sponsor, maybe want to curb it to 250K. But I would say our sweet spot is going to be anywhere between 250 to a million in a deal. And if
I
it's
see.
over a million, it's going to be specific exceptions because we really like this deal, we're already done with that sponsor. And 250 is more like, hey, we're still new, we want to try it out and see what it is. So it's really goes in a range. For example, let me give you, there was a couple of times where we needed to reach a threshold in order to get the preferred economics. Me and Jesse put extra money. We bought extra slices in the deal. Not only that I had my own share in the deal, but we had to buy extra, 2 extra seats effectively, 2 extra seats for that deal. And as we onboarded new investors, they come in with money. We're like, okay, why don't you actually take over these slices if that fits your criteria?
That makes sense. I like that. Okay, makes sense. Very cool. All right. Anything else about how you look at deals, how you look at the GP that I haven't asked you that you think is very important for the audience to know?
There are cases where you met GPs and you thought they're awesome, and then you've invested with them and you've realized that a lot of your perceptions and all your questions did not fully extract out some of the things that you're sensing post investments. It does happen. It happened with me. Remember, I started investing in these things for quite some time. Like I say, is do all your vetting, and at the end of the day, if you feel something is off, maybe go back and ask yourself why you're feeling something is off. That's one part. If you cannot find the answer, maybe scale back your investments, go a smaller amount, try them out. You don't have to wait 5 year cycle to really decide to deploy more, but feel them out, see how they're reporting, see how they're doing. So what's their communication style? For me, big part about it is not just a deal that perform or doesn't perform, but also how well it communicates. I've had a situation where a GP performed super well, but their communication thing is awful. And once a month, I'm collecting all that intelligence and summarizing it for the rest of the investors. to give them an update because a lot of them are busy tech professionals, vice presidents, or they don't have the time. So I really make an executive summary once a month. Here's the status of everything, and literally one bullet per investment. So I really need to have that data to just give them enough because even though they can get all the asset reports up on the portal, but they don't really care about that. They want to get a high level executive summary, what it is, what is it that they're going to have. So that's really for me, communication from the GP is essential. And it's hard to assess that. So part of the due diligence process is we ask for references of existing investors, investors that invested with you once and did not invest again, and investors that invested with you multiple deals. And we actually meet these people. We literally call them, talk to them, and have a different set of questions what we're asked to really extract a little bit more about the character.
Gotcha. Very good. All right, BD. We're gonna wrap up this interview part and open up for Q&A here. But before we open up for Q&A, for those that want to reach out to you, whether they want to be a part of your club or part of your investor group, whether they want to be a part of your investor group as an LP to join in with you, or they want to be bring deals to you as a GP, where would you like to send them? What's the best way to reach out to you?
Sure, I'm available on social media. On LinkedIn is probably the biggest channel. Sometimes we do get overwhelmed with the requests and the communication, but Dweik is the name on social media. The Our website is Bluestone. The name of our investment group is Bluestone Flagship Investors, so it's BFIfund.com. And then there's a contact button. There's a Calendly. They can book an appointment. They can get on the call. And like I said, we're always open to meet people, expand the network. We value being in a platform like yours mainly to get exposure and more deal flow and just broader reach. And we enjoy like hanging out. I've been joining your group and I've been actually sitting in let me get that right, capital party for quite some time.
Love it.
And there's just tremendous amount of people that come in on your platform. They share so much knowledge and wisdom, and it's a great way to get like-minded people in a room. So kudos to you, Tim. It's always amazing how you drive communities. This is like a whole skill set on its own. Maybe one day we bring you on a platform and ask you about what's your secret sauce? How do you drive community?
I
And
would be honored, yes.
and yeah, just reach out. We're always open and we're always happy to answer any questions for people.
And that's one of the things I love about you is you're always so generous. You're easygoing, you're super generous with your time, with your knowledge, your wisdom. Yeah, thank you for supporting me and my team whenever we reach out to you, have questions, brainstorming with you, ask you to be on one,